In this slide, we turn to our quintessential football field, and I think this is going to look very familiar to you guys since this is the same layout that we used back in our trading comps analysis, but this time we've overlaid now just the implied share prices to Nike based on our transaction comps multiples, be it LTM EV to sales, LTM EV to EBITDA, etc. So we're doing the same type of analysis, same type of math that was done back in the trading comps analysis, but in this case, just imputing the share price implied by transaction comps. So when I eyeball our graph here, keeping the premium analyses off to the right out of the mix here, when I eyeball this, I'd say midpoint is probably around $60 per share. If I were to give it a rough range, I'd say that our multiples imply a range between $50 to $75 per share for Nike. But what's surprising about this is these are M&A comps, and so you'd expect a high premium or a high valuation to kind of hit that hurdle to actually transact here. But Nike, at least as of the time of making this video, is trading for around $100 per share. So on a multiples basis, I'd say this analysis really isn't that meaningful. And as we know, the recent deals were just not very comparable. Even the older deals that we used, it was just too long ago. And there's also reasons, for example, that just the businesses we looked at were significantly smaller than Nike. Now, with that said, I think one thing to now turn our attention to is the significant difference we see in valuation implied by our premiums paid analyses relative to the multiples. So premiums paid are kind of, they're a little bit more agnostic of multiples here because you're just looking at a premium to the share price. And our big takeaway from this, I think, is seeing that these are certainly in excess of where Nike is currently trading, is that by focusing on premiums to publicly traded share prices, rather than on implied share prices based on valuation multiples, I think we can derive a more realistic valuation of what may actually be accepted by Nike shareholders if there were some sort of M&A event. So, of course, they're not going to transact for anything below where Nike's trading. Otherwise, they just liquidate their shares on the market. So, if there's any useful takeaway from our transaction comps, I'd say it would really be the premiums paid analysis, that I think this gives a realistic picture of what Nike would trade for if it were to be acquired. Now, one last comment I will make here is that it's highly unlikely that Nike would be acquired. If we're being realistic here, being valued at around $140 billion, there's not that many, I don't know of almost any suitors out there that could acquire a company like Nike. Maybe you would try to back into a valuation for a merger. Let's say you had a mega merger like Nike's and Adidas or something like that, assuming that wouldn't run into any antitrust issues or anything along those lines. But let's keep this in a vacuum. Maybe you could value it for that. But overall, I think what I'm getting at here is that precedent transactions just probably aren't the most realistic valuation method for a company like Nike due to a plethora of reasons.